Welcome to The Explainer. Today, we're diving into a really practical topic for anyone who has income from property. What do you do when rent is paid years late? We'll be breaking down the specific rules under Section 23 of the Income Tax Act that deal with arrears and unrealized rent. So, let's kick things off with a scenario that's probably more common than we'd like. Imagine a tenant who vanished years ago suddenly gets in touch and pays you a lump sum for all the rent they owed. I mean, it's fantastic to finally get the money, but what about the tax? Is it taxable, and if so, how? This is the exact question Section 23 is designed to answer. So here's our game plan for today. We're going to start by looking at the core problem. Then we'll unpack the really important conditions of Rule 21. After that, we'll see how the tax is calculated, run through a quick example, and wrap up with some compliance tips and the main things to remember. All right, first things first, let's set the scene. For any landlord, dealing with unpaid rent is, unfortunately, this part of the territory. Now, the tax law is pretty specific here. It draws a clear line between arrears, which are just delayed payments, and unrealized rent, which is rent you've pretty much given up on and written off as a bad debt. The answer to our problem is sitting right there in Section 23 of the Act. But, and this is a big but, you can't just jump straight into Section 23. There's a prerequisite. You first have to get familiar with a connected provision called Rule 21 of the Income Tax Rules. Think of Rule 21 as the key you need before you can unlock Section 23. And that brings us to a really foundational part of this whole discussion, the 4 conditions under Rule 21. If you've ever claimed a deduction for rent you couldn't collect, you had to have met these conditions. Understanding them is absolutely key to taxing the money correctly when you finally recover it. So let's get the official definition down. According to the income tax rules, unrealized rent isn't just any old overdue payment. It's rent that you can actually prove was lost and was impossible to recover. And where does that proof come from? Well, it comes from meeting 4 very specific conditions. So here's that 4-point checklist from Rule 21. First, the tenancy has to be genuine. Bona fide is the legal term. Second, the tenant who didn't pay must have actually vacated the property. Third, and this is a smart one, they can't just be renting another property that you own. And finally, number 4, which is so important for compliance, you have to show that you took reasonable legal steps to get your money, or prove that doing so would have been pointless. All right, so now that we've laid the groundwork with Rule 21, let's move to the main event, Section 23 of the Income Tax Act. This is the part that tells us exactly how to treat that lost rent for tax purposes once it's finally recovered. Section 23 is based on 3 really simple but powerful principles. First is timing. You pay tax in the year you actually get the money, not the year it was originally due. Second is the category. It's always considered income from house property. And third, and this one often surprises people, is ownership. Even if you sold that property years ago, if you recover old rent from it today, it's still your taxable income. Now, here is a bit of good news from the tax department. You don't get taxed on the full amount you recover. Section 23 gives you a flat standard deduction of 30% right off the top. This is supposed to cover any expenses you might have had, and the best part is you don't need any bills or proof. It's totally automatic. You know, theory is one thing, but let's make this real. We'll quickly run through a calculation to see exactly how this all plays out with actual numbers. It really is as straightforward as this looks. Let's say you recover 1 lakh rupees in arrears. First step, you apply that 30% standard deduction, which comes to 30,000 rupees. That leaves you with a taxable income of 70,000 rupees, which is what you will add to your income from house property for that year. Simple as that. Knowing the law is half the battle. Applying it correctly is the other half. For all the professionals and business owners watching, avoiding the common mistakes is absolutely key. So let's look at some practical things to keep in mind. Here are 2 classic mistakes people make when it comes to those Rule 21 conditions we talked about. A really common one is trying to claim unrealized rent without any documentation of recovery efforts. The right way is to have a file with legal notices or other proof. Another slip-up is forgetting to check if the tenants simply moved into another one of your properties. If they did, you can't make the claim. You have to be sure they vacated all of your properties. So the clear message here is all about documentation. The best practice is to keep a detailed file with the tenancy agreement, all your communication, copies of legal notices, and proof that the tenant has left. And, of course, the final step is to make sure you declare that recovered rent in your income tax return for the year you received it. Okay, we've covered a fair bit of ground. Let's just quickly recap the most crucial points from our discussion on Section 23. So if you remember anything, remember these 5 points. 1. Recovered rent is always income from house property. 2. Tax is based on the year of receipt. 3. You always get that flat 30% deduction. 4. It doesn't matter if you still own the property. And 5. For unrealized rent, meeting those 4 conditions in Rule 21 is absolutely non-negotiable. And I'll leave you with a final thought to chew on. Now that you know these rules, especially the strict documentation that Rule 21 demands, how might you change your process for handling and recording tenant defaults from now on? A bit of proper documentation up front can really save you a world of trouble later. Thank you for watching this explainer. If you found it helpful, I'd really appreciate it if you could like, subscribe, and share it with your colleagues. And finally, just the standard disclaimer. This video is purely for educational purposes and isn't professional advice. Tax laws are always subject to change, so please do consult your professional advisor before taking any action.